You've probably noticed this. It looks like the line crossed the signal line, in this case from top to bottom. You enter the trade by all the rules, but then the price immediately reverses and goes against you. Sound familiar? First, let's quickly review the anatomy of the indicator. The MACD consists of 4 key elements. First, there's the zero line, which is the balance level between buyers and sellers. Second, there's the MACD line itself, which is usually calculated as the difference between the 12-period and 26-period exponential moving averages. Third, there's the signal line. This is a smooth version of the MACD line, usually a 9-period one. And fourth, there's the histogram, which visually shows the distance between the MACD line and the signal line. The farther apart they are, the stronger the momentum. The classic rule for using it is simple. When the MACD line crosses the signal line from below, it's a buy signal. From above, it's a sell signal. But as you probably guessed, we're going to take it a step further. So what's the main problem with the standard approach? Imagine the market is in a steady uptrend. The price keeps rising and suddenly the MACD gives an upward crossover. A beginner happily opens a long position and ends up with a loss because it was just a dead cat bounce, not a continuation of the trend. The indicator worked, but the context was ignored. To solve this problem, we introduce a simple yet brilliant rule. We'll only consider signals if they come from the right zone. For long signals, the MACD line and the signal line must cross only below the zero line. Why? Because if the lines are above zero, the market is already overheated, and any upward signal could turn out to be a trap. For shorts, on the other hand, the crossover must happen strictly above the zero line. In other words, we're catching the moment when the momentum is just starting, not when it's already spent. Let's take a look at the chart. Here, the MACD gave a downward crossover, but both lines were below zero. We skipped this trade. But here, the upward crossover happened below zero. This is our potential entry point. But even with this rule, there's still false signals. For example, during a strong trend, the MACD will still occasionally try to reverse, creating noise. To finally filter out this noise, we'll add a second indicator. We need the EMA cloud 150 to 250 from this author. Let's add it to the chart. Now look, when the cloud is green, the market is in an uptrend. We only look for long positions. When the cloud is red, the market is in a downtrend and we only look for shorts. This is our global filter. Setting up the indicator is ridiculously simple. We leave all the default settings and only change the color scheme to something easy on the eyes. Now we have 2 indicators that work together like gears in a clock. Let's put everything together into a single system and walk through the steps using specific examples. To enter a buy trade, here's what we do. Step 1. Look at the EMA cloud. It should be green. This is our global direction filter. If the cloud is red, we don't even look at long MACD signals, no matter how good they might look. Step 2. Wait for the MACD line to cross above the signal line on the MACD. This is a classic bullish crossover. Step 3. Check the zone conditions. This entire crossover must happen strictly below the zero line. If the lines cross above zero, the signal is weak. Skip it. Step 4. If all 3 conditions are met, green cloud, upward crossover, below zero, we open a trade on the next candle after the signal forms. That's how we handle the entry. Now let's talk about the most important part. Where to set your stop and where to take profit. We place the stop loss just below the last local low before the signal. This is the most logical spot, because if the price breaks through this low, it means the structure is broken and our signal is most likely false. Now about take profit. We're not going to guess or use random levels. We'll set the target so that the risk to reward ratio is at least 1 to 2. So if we're risking 50 points, our target should be at 100 points. This is the mathematical edge that makes the strategy profitable over the long run. Let's look at an example. Here's a signal. Stop goes behind the local low. Target is set at double the distance. The price reaches the target without any major pullbacks. The trade closed in profit. The logic works the same way for short positions. Let's break down a short trade step by step. Step 1. The EMA cloud must be red. No exceptions. Red cloud, look only for shorts. Step 2. Wait for the MACD line to cross the signal line from above downward. This is a bearish crossover. Step 3. Check the position of the crossover. It must happen strictly above the zero line. If the lines cross below zero, skip it. Step 4. Open the trade on the next candle. Set your stop loss just above the last local high before the signal. The target is twice the risk. Here's an example on the chart. All conditions are met. The trade hits the target. Profit is locked in. And now the promised bonus. At the beginning of the video, I said I'd show you an improved version of the MACD that gives signals earlier than the classic one. Meet the Zero Lag MACD by Albert Callista. What makes it special? The name speaks for itself. This is a MACD with zero lag. Thanks to special mathematical data processing, this indicator reacts to price changes much faster. Let's add it to the chart and set it up. In the style settings, I recommend turning off the EMA display on the MACD line and making the remaining elements more noticeable. Long entries are marked with green circles, short entries with purple ones. Visually, this is much more convenient and clearer than trying to decipher a tangle of lines. Now for the most interesting part, the comparison. Take a look at the chart. A classic MACD gave a buy signal right here. Now take a look at the zero lag MACD on the same section. See? The green dot appeared 3 or 4 candles earlier. These are real-time hours that give you the chance to enter a trade at a better price and with a tighter stop loss. It's the same situation for shorts. Here's the trade we looked at earlier with the classic MACD. The entry's here. The zero lag MACD marked this signal with a purple dot 2 candles earlier. Can you imagine the difference in potential profit? At the same time, the rules of our strategy remain exactly the same. For a long position, you need a green circle below zero and a green EMA cloud. For a short, you need a purple circle above zero and a red cloud. As I mentioned earlier, this indicator is ahead of the original MACD, and you can clearly see that. For example, right here, the conditions for a long trade based on the zero lag MACD are met, and it turned out to be a successful setup. But if we look at the original MACD, we can see, first of all, that the crossover happened as many as 10 candles later, which on the hourly time frame equals 10 hours. That's a huge difference. And secondly, on the original MACD, the crossover happened above the zero line. So basically, the conditions for the trade weren't met at all, and we missed out on a really good opportunity. And there are countless examples like this. Which version of the MACD to use, classic or zero lag, is up to you. The classic version is more conservative. Zero lag offers more opportunities, but it requires a bit more careful attention because of the earlier entries. The main takeaway from this video is that even the good old MACD can become a powerful tool if you add the right filter and clear risk management rules. Test the strategy on historical data before using it for real and adapt it to fit your own style. If you found this video helpful, give it a like and subscribe so you don't miss out on new tools. Wishing you successful trades!